Hey guys, it's Adrian here, the Canadian in a t-shirt, and today I'll be breaking down what is investing, what is the stock market, and what are stocks. These fundamentals of investing are useful for anyone, but I will be targeting my advice towards young beginners and Canadians in particular. I'll be covering the basics of what are stocks, dividends, and capital gains, and how you could use these to build wealth in the long term. This is the second video in my Millennial Investing Guide, so make sure you check out my last video where I covered the 4 steps to building wealth, with investing being the last step. It's really important to understand steps 1 to 3 before you dive into investing, so click the pop-up at the top right to watch that video first. As a quick recap, the 4 steps to building wealth are paying off your credit card debts, reducing your spending, setting up an emergency fund, and finally, investing. This is important. You should not even think about investing until you've paid off your credit card debt and you have an emergency savings fund topped up. For my longtime viewers, this video is actually a remake of one of my very first videos from 2 years ago. Back then, I was filming with my cell phone, so the audio and video quality were awful, but the information is still incredibly relevant today. So I wanted to make an updated version to reinforce this important lesson. So with that, let's jump into the world of investing. Investing is any time you put money aside today with the expectation that you'll be able to make more money in the future. And when I say future, I don't mean next week or even next year. Investing is a long game. People who buy and sell stocks multiple times throughout the day are not investors. They are day traders, and I do not recommend this approach to anyone, especially not to beginners. In the short term, the stock market is very unpredictable, so buying and selling stocks within days is essentially gambling. In fact, you probably have better odds going to the casino. Instead, you need to think about investing in the long term. Do not try to get rich quick. It's not going to happen. And if anybody promises you that, it's a scam. All of the investments in my portfolio really show their value over the course of 10, 20, or 30 years. And that's a perfect timeline for millennials, people in their 20s and 30s. Maybe you're just out of school, entering the workforce, and you have 30 years ahead of you before you retire. So you really need to start investing now to take advantage of those decades of investment growth. That time is a gift. I really want to hammer home the point about investing in the long term. A common misconception is that investing in the stock market is super risky and you can lose all of your money at the drop of a hat. But that's only really true if you're investing in the short term. In the long term, the stock market is very reliable. Here I have a table showing different time frames and whether the US stock market gained money or lost money between 1926 and 2015. Over the course of these 90 years, about 54% of all days the market went up and 46% of the days the market went down. So if you're buying a stock today and selling it tomorrow, you basically have a 50-50 chance of losing money. But if we look at a 1-year time frame, 74% of the years saw the market go up since 1926. Even further, looking at a 10-year time window, 94% of these 10-year windows, the market gained money. So if you invest in the stock market at any time and you hold it for 10 years, you have a 94% chance of gaining money. Looking at 20 years, there has never been a 20-year period in the history of the stock market that didn't see a positive gain. Even through the Great Depression of the 1930s, through World War II and the financial crash of 2008, and yes, even through the stock market crash of 2020, the stock market has never lost money over the course of 20 years. So if you are a young investor and you invest in a diversified portfolio for 30 years until you retire, you are historically guaranteed to make a profit, and a considerable one at that. I think of investing as planting a seed. If you come back after a week and dig it up, all you'll have is the seed. You haven't gained anything. But if you give it time and you let it grow, that seed has become an apple tree. And now you can reap the rewards of your investment and cash in on all those apples that you have. Or even better, let that tree be. Let those apples fall to the ground and those apples will plant new seeds. And now, every 10 years, your tree will plant new seeds and those trees will plant new seeds. After 30 years, your single seed has become an entire orchard of apple trees. And that's the mentality I want you to have with your investments. Whenever you have a profit, don't just cash it out. Reinvest that profit and let your investment compound and grow faster and faster. That's how your investments can give you exponential growth. And the true power of exponential growth is letting it run over a long period of time. This is very important. Do not invest with money that you'll be needing in the next year or so. If you know that you're buying a house next year or starting university, do not put that money into any type of investment. Instead, put that money aside in a savings account where you can earn a modest interest rate of about 1%. Your savings won't make you rich, but that money is guaranteed to grow at least slightly in value, and more importantly, it will not lose value. You can withdraw that money anytime at all, and it will always be there for you with zero risk. Right now, the best savings account in Canada is with EQ Bank, and they're offering an interest rate of 1.25% with no monthly fees and no minimum balance. If you'd like to get started, click my referral link in the box below to sign up and to help support my channel. So if you need to spend this money in a year or two, put it in a savings account where it's safe. The money you put into investments should be money that you're not going to touch for at least 5 years. So what are the different types of investments? Today, we're going to be focusing on stocks, but you can also invest in bonds, ETFs, mutual funds, REITs, and real estate. I've already made a video on each of these topics, so make sure you check those out. Stocks are the basic building blocks of investing. A stock represents a unit of ownership of a company. Stocks are also called shares because when you own a stock, you own a share or a piece of the company. So if a company like Walmart has 100 shares available and you own 10 of these shares, you own 10% of Walmart, and thus you are entitled to 10% of Walmart's profits. These units of ownership are bought and sold over the stock market. These stock markets include the New York Stock Exchange and the NASDAQ for American companies and the Toronto Stock Exchange for Canadian companies. The interesting thing is that a stock, this unit of ownership, doesn't have any inherent value. Its value is how much someone else is willing to buy it for. That's why the value of a company's stock changes every second of every day, even if nothing is changing about the company. An hour from now, if enough people start offering to pay more for the same stock, it's now worth more and its value rises, even though nothing has really changed. So when you look at a stock's value over the course of a day, these random fluctuations are meaningless. What we actually care about is the long-term growth of a stock over the course of years. This represents real growth in the company. For example, this is the value of Apple stock over the course of a day. These fluctuations mean absolutely nothing. Some people were just willing to buy and sell for $1 higher or lower than other investors. Nothing actually happened to Apple as a company to explain these fluctuations. But if we look at Apple stock over 13 years, we can see that after 2008, when the original iPhone was released and gaining popularity, Apple saw incredible and consistent growth year after year. Until today in 2021, when the stock of Apple is worth 40 times more than it was back in 2008. This is the real kind of growth that we care about as investors. Ignore the short-term fluctuations. Focus on the long-term growth. Stocks can earn you money in two ways: capital gains and dividends. Capital gains means that the stocks themselves are worth more today than the price that you bought them for. So if you bought 10 shares of Facebook at $200 each, your initial investment is $2,000. Fast forward 5 years, and now Facebook stock is worth $300. You still own the same 10 shares of Facebook, but now each of them is worth $300, and so your total investment in Facebook is worth $3,000. That's $1,000 more than you bought it for, so you have $1,000 of capital gains. But this is important. You haven't made that $1,000 profit just yet. Your stocks are worth $3,000, but you don't get that money until you decide to cash out and sell your stock. This concept is extremely important, even more so when stocks drop in value. Let's say there was a data privacy scandal and Facebook stock plummeted to $150 a share. That means that your 10 shares are only worth $1,500. That's $500 less than you bought it for. You might be worried that you just lost $500 in this investment, but you really haven't yet. You haven't lost any money until you decide to sell your stocks. The moment you sell your stocks, that's when your gains or losses are realized. Until you sell, that $500 loss is just a fictional number telling you what you would get if you decided to sell, but you don't have to sell. Instead, hold on to those 10 shares you have, and after a couple of months or a year, Facebook stock will bounce back and you'll be at a profit once again. So that's how capital gains work, the most basic way to make money in the stock market. Basically, buy low and sell high. The second way to earn money with stocks is dividends. Dividends are a percentage of the profits that a company pays out to its investors. Back to the Walmart example, if you own 10% of Walmart stocks, you own 10% of Walmart. And so every 3 months or every quarter, Walmart will pay you up to 10% of their net income. And this is called a dividend. The best part is that you don't have to do anything to earn this money. If you own at least one share, the company will pay you a dividend. And the more shares you own, the more dividends you get. Dividends are a great way to encourage investors to invest in the long run. With capital gains, you only make money when you sell your stocks at a profit, but with dividends, you earn money every 3 months, whether the stock goes up or down. So if you held on to TD stock for 5 years, and over those 5 years, the stock price remained flat, then when you sell it, you haven't earned any capital gains. But every 3 months, TD has been paying you a dividend in cash, so over 5 years, you've still made a profit because of these dividends. Ideally, you want to take advantage of both dividends and capital gains. That means you want to invest in a company that pays you a dividend every few months and in a company whose value grows year after year. Unfortunately, not all companies do both. In fact, there are a lot of companies which don't pay a dividend at all. These are usually new companies who aren't making enough of a profit yet to justify paying out dividends, or they could be tech companies like Apple, Facebook, or Amazon who pay little or no dividends. The rationale here is that these tech companies would rather invest their profits into research to develop a new product line to release in a year or two. And this research and new product should increase the value of the company significantly. And so the investor should be earning more money through this capital gain than they would be if they received a dividend instead. Sometimes this trade-off is justified and other times it's not. But you have to be prepared for the fact that some companies just don't pay dividends, and some companies can decide to stop paying their dividends. Since dividends are more or less optional for a company, we can divide stocks into 2 main categories: growth stocks and dividend stocks. Growth stocks are the companies that pay no dividend, or they pay such a small dividend that it's negligible. Again, these companies would rather use that money to invest in themselves, to grow, to research a new product, or to expand into a new market. When investing in these growth stocks, your only goal is capital gains. That means you want to buy these stocks at a low price and sell them years later at a higher price. Growth stocks include new companies which are just starting out, like Tesla and Shopify, but they also include older tech companies like Apple and Microsoft. On the other hand, dividend stocks are the companies which are known for paying significant dividends and for increasing their dividends over time. These are usually well-established industry leaders that we call blue chip stocks. These companies are worth tens of billions of dollars, and they've been around for decades. Because they're already so large, there isn't a whole lot of room for them to grow. They're still extremely profitable, but they're not going to quadruple in size the way a new company like Netflix did. Instead, these companies attract investors by consistently paying dividends every month or every quarter. Dividend stocks are generally much safer than growth stocks because these companies are so well established. Still, it is possible for a huge titan to fall, like Blockbuster, Nortel, and Enron, but these are incredibly rare. Dividend stocks include well-established companies which are staples of the industry, and they reliably make profits no matter what is happening in the markets. These include banks like TD and BMO, energy and utility companies like Enbridge, telecommunications like Rogers and Telus, and consumer goods manufacturers like Coca-Cola and Procter & Gamble. I've talked about my favorite dividend stocks in my Stocks to Buy playlist, so check those videos out. The strategy with dividend investing is to buy a company which has a long history of paying dividends and increasing its dividends every single year. For example, BMO, the Bank of Montreal, has never missed a dividend payment in 190 years. Ever since 1829, BMO has paid dividends out to its investors every single quarter, and almost every year they increase their dividends. Dividends are a fantastic source of passive income as long as they are sustainable, and that leads me to a very important warning. Do not invest in a company just because they pay out a huge dividend. Most of my favorite dividend stocks pay out a dividend yield between 4 and 6%. Anything more than 6% is probably too good to be true and is cause for concern. There are some companies out there which are in financial trouble, and they are desperate for investors to help them out. And one way to attract foolish investors is to offer ridiculous dividends of 15 or 20%. This is a trap. Sure, it gets my attention, and on paper, it looks like I'll be earning 20% returns every single year. But if you dive into the financials, you'll see that there's no way that this company can sustain this kind of dividend. In a lot of cases, you'll see that these companies are paying out more than double their income out to dividends just to attract investors. So every year, these companies are losing money and digging themselves deeper and deeper into debt until eventually they'll have to cut their dividends, or even worse, they'll have to file for bankruptcy. I've already made a whole video on dividends and how to invest in them the smart way, so make sure you watch that video before you get super excited and start chasing those high dividend traps. Whether you want to invest in growth stocks or dividend stocks, make sure you check out my step-by-step walkthrough on how to buy stocks in Canada using Questrade, which is my favorite online broker. I also cover how to buy US stocks for Canadians and how to open an investing account, so click the pop-up at the top right to check out my investing tutorials. And if you want to get started with investing, I'll include my referral links in the box below to both Questrade and WealthSimpleTrade, which are my two favorite investing platforms in Canada. So there you have it, that's my quick intro into the world of stock market investing. I hope I gave you a solid understanding of the importance of investing in the long term, how to earn money through capital gains and dividends, and the difference between growth stocks and dividend stocks. If you'd like to see exactly which stocks I'm invested in and to help support my channel, hit that join button down below to gain access to my exclusive members only videos like my TFSA and RRSP portfolio reveals, and to see exactly which stocks I'm buying every few weeks. But remember, don't just blindly follow a random guy on YouTube. Everyone has their own financial goals and circumstances. I don't want you to copy what I do, but I hope that seeing my portfolio might offer you some guidance, especially if you're just getting started. Thanks for watching, guys, and be sure to like, comment, and subscribe if you found this video helpful. Every thumbs up and comment really does help me build this channel on YouTube, and hit that bell icon to be notified of my new videos. And if you'd like to follow me on Instagram or Facebook at Canadian T-shirt, click the link in the box below or click the links on my homepage. Thanks everyone, and I'll see you guys on the next episode of the Canadian in a T-shirt. Bye guys.